You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest, Senior Options Analyst and author of the Options Playbook. So the last couple of weeks, we've been looking at some trades outside of earnings, but in the S&P 500 index. And we've looked at a few interesting strategies, looked at a skip strike butterfly. And now last week, we looked at a long call spread. And guess what? This week, I want to look at a bearish butterfly. We're going to look at to the downside on the butterfly based off of where the markets are at, with the SPX trading today at 2,888.60. And we also have the VIX index very close to 14. It actually closed right at 13.91. It is up 3/4 of a point on the day. So with that being said, if you have an options playbook on your table, you just want to look for a long put butterfly. But if you don't have one, that's fine. Just go to optionsplaybook.com. You can always go to the strategies tab and look for long put butterflies there. That'll give you a little bit of a hint. And then we'll recap actually last week's trade. We'll look at what happened in that position. And that is a long call spread, which you can also find in both of those locations. So let's start with the recap. Last week, we looked at the S&P 500 index. The market was open. It was Wednesday. It was the 29th of August. The market had been trading for a little bit. We came on in, and the market was, and it was easy to remember because it was right at 2,900 when we were taping Options Playbook Radio. And we decided to do a 5-point wide long call spread. And the whole genesis of the trade was that we are going to sell an at-the-money option, bring in a boatload of time premium, because that's where the bulk of the time premium is at, and then go 5 points in the money and buy an option contract. So we're going to have a little bit more downside than upside, but because we were selling more time premium, we were bringing in more legit time premium than we were buying. That meant that if the market just stayed where it was at, we were going to do fine on that trade. And with the market did work out for us. When we put on the trade, the market was at 2,900. Like I said, the market continued on up. By the end of the day, the market was closing at 2,915. Probably should have been out of that trade. If you did not, it kind of danced around, but it really didn't get below 2,900 all the way until almost the end of the day on Thursday. So if you weren't out of the trade at that point in time, you should have received the stupid award. But if you wanted to, you could have rolled it into the butterfly. And that's what we talked about. With it at 2,900 at the end of the trading day on the 30th, you could have potentially just rolled it into the butterfly, which was the other trade that we were talking about. We were long in this instance, the 28.95 call, short the 2,900, And what we were mentioning as a hedge would have been to sell another 2,900 and then buy the 2,905, and hence bringing in a credit for that spread to hopefully pay for the long spread to start with and give yourself a little bit more of a profit. So you could have, if you stuck around long enough, you could have found yourself in that scenario and maybe rolled into that butterfly. And that would have turned out really well if you would have did that. At the end of the trading day, there were many times where it was actually trading right at 2,900. But on the end of the trading day on 8/31 on the Friday going into the long holiday weekend, one of the last prints was right at 2,900. So you couldn't have done better than that. You would have received the 5 points for the spread at the very end of the trade for the butterfly, or approximately, and you would receive the net credit along the way while you did the entire trade. So the market worked out very well. So let's stay in the S&P 500 index. And once again, whenever we talk about anything on Options Playbook Radio, it's just about timing. Nothing's meant to be recommendations. We'd like to look at a boatload of different strategies. And ideally, I in my own personal trading, I don't do as many strategies as we talk about on Options Playbook Radio, but we try to look for scenarios where a long calendar spread might make sense versus a vertical spread, or a butterfly might make sense in this instance versus just buying a put outright. And that's what we're going to look at today. So we haven't done a trade to the downside in this series on the S&P 500 index. So let's do one. I don't know where the market's going. I'm going to flip a coin, and we're going to be bearish in this instance. And that's going to play hand in hand into our long put butterfly. And once again, we're going to talk about a hedge on that trade. It'll be a short-term trade. We're just trying to learn here on Options Playbook Radio. So obviously a paper trade, and we'll follow it. As of right now, the market is closed. It is September 5th. It is a Wednesday. The market closed on today at 28,888.60. It was down $8.12. So that's a fun one to say. So a 2 4/8 behind it is where the market closed at. And we're going to go only a 2-day trade. Once again, we're taping on Wednesday, so that means we're going to have all day Thursday. The market's closed, so we're going to have all day Thursday for this trade to play out, and all day Friday for the trade to play out. And if we look at the put butterfly trade that we're going to do, what we want is to go. We want to be within a potential range that the underlying market could do over that time period. And the fact that the VIX index is fairly close to 14 makes butterflies cheaper. If you have higher implied volatility when you put on the butterfly, they are much cheaper than the latter, than putting on the butterfly and then having implied volatilities go up, especially if you're correct on your forecast. So we like where the vol is at. The fact that it made a little bit of a spike up today even makes this strategy more interesting, because the butterfly will be cheaper than when the volatility is down around 10, 11%, and just relative to the VIX is the best way to go. So we're going to go just a little bit out of the money. The market's at 2,888. We're going to start by buying the 2,885 strike put, nearest term expiration. We only have 2 days to go. We're going to go 15 points because 15 points is feasible. If I look at the at-the-money straddle, we see that the at-the-money straddle is trading somewhere around 17 if we've just bought the put and bought the call outright, and that would be the 28.90 long straddle. So we want to be somewhere within the range. The marketplace thinks that that's a potential move, and we wouldn't mind if it made that type of move. So we're going to go about 15 points down. We're going to go out and buy. We have 2 days remaining to expiration. So this is the September 7th expiration, 2018, obviously. And we'll buy the 2,885 strike put, go and sell 2 of the 2,870 strike puts, and then we're going to go down another 15 points to make it just a good old standard butterfly and buy the 2,855 strike put. So this is a 15-point wide butterfly. We're leaning towards the downside. We'd like to see about a 20-point wide move to the downside. And we see this entire butterfly trading at the midpoint for $2.05. And like I said, that's a very reasonable price to be within a range that the S&P 500 index could move based off of the expected move before that Friday expiration. So basically 2,888 down to 2,870. That's where the ideal scenario would be. These are considered the weeklies, so this is going to trade all day Thursday, all day Friday. The settlement price will be determined by the close on Friday, so you have 2 full days of trading. And we're going to pay $2.05 for this trade. Our upside will be 15 minus that $2.05. So our max upside is $12.95. But we're never going to get that. We're only looking to make $1 or $2 in this trade, and then we're just going to get out. If we made $1 on a $2 investment, we would be doing extremely well, and we would obviously just get out of that trade. All right. So if we put this trade on, we get it off on the open, we fill somewhere around that $2 midpoint. What's our plan? What do we want to happen? We would ideally like the market to open down. If the market did open down and it started drifting slowly towards the 2870 mark, well, we just stay the course. We don't want it to gap down. If it gapped down 30 points, well, then it's going to be all the way down on the other side. Implied volatilities are going to be up, and it's going to make the butterfly more costly on top of everything else. So we really don't want the big gap down. We'd like a general move to the downside over the next 2 days going into that Friday expiration. If the market goes up, well, what we're going to do here is just roll this into a short put spread. So right now we've paid $2 for this trade. And once again, our hedge is just going to be, I don't want the cheese anymore. Just let me out of the trap. But what we would do is go out and sell the most expensive option contract and then use those monies to pay for the least expensive option contract. So in this instance, if the market went away from us and it started going on up, it went to 2890, 2895, and it started trading 5 to 10 points higher than where it currently is at, what you'd want to do is go out and, keeping your whole gaggle of securities, you're going to sell to close the 2885 strike put and buy to open one of the 2855 strike puts. So you're selling the more expensive option contract and you're buying another 2855 strike put. That puts you in a 2x2 short put spread, and that put spread would be 15 points wide. In other words, you would be short 2 of the 2870s, right? Because that's where the middle strike of our butterfly was, and you would also be long 2 of the 2855s. Now, this would increase your requirement, and you'd have to have that in your account before you did the trade, because now on your 1x2x1 butterfly that had very limited risk down to $2.05 at the midpoint, and you always got to remember to throw in commissions. Now you would have this short put spread 2x2, so 15 points, which is $1,500 per spread, and you did 2 of them. So now you have $2,000, or I'm sorry. So now you have $3,000 worth of risk, and that would be your margin requirement on this trade. Now, if we're doing that, though, remember, the market is in a rising market. You have 2 days for this whole trade to play out. The market has gone up, and now you're looking at the 2870 put versus where the market was when we started this, which was 2888. So it's already up 10 points higher than that. You're hoping to bring in a net credit that would be somewhere close to the $2 that we paid for it. Right now, that spread that we would be looking to roll is trading for at the midpoint $5.60. So if that thing starts to get down to the point where it's trading for $3 or it's trading for $2.50, then you're going to want to roll, because you still want to be able to receive a net credit in this trade. If you are dead wrong on your forecast, if you are completely wrong on your forecast, you still want to be able to make something out of it. But we're really looking to just try to get out of the trade and make good on our mistaken forecast. Okay, so we put on a butterfly. The market goes with us. That's great. If it goes against us, we roll into a short put spread, but it will be a 2x2 put spread. And then if we're wrong again over this 2-day period, we just get out. You just cut your losses. If you get whiplashed, the market's running on the way up. It's running with you it's running against you. You roll into the short put spread, and all of a sudden it whiplashes and starts coming straight down towards your short put strike. Get out of the trade. Just you got a lot of risk on the downside. You don't want to be into that trade that long. And that's part of the reason why with this type of strategy, we're only doing it for 2 days. I'd maybe do it started on a Tuesday. We did it on Wednesday, maybe get 2 to 3 trading days total on this type of trade. And it's mainly because of how you plan to hedge this underlying. All right. So that's it for this episode of Options Playbook Radio. If you have a question you'd like us to answer on the program or a topic you'd like us to discuss on the show, you can send them directly to me at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. Thanks for listening, and we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.